Bismillahirrahmanirrahim. Dear students, welcome to the class of Introduction to Business Finance. As this is our first lecture, I'm introducing myself. I'm Azizur Rahman Khatir from Ningrahar. I have completed my basic education, my bachelor degree, my master degree from Pakistan. I'm connected with the field of teaching from the past almost 5 years in different universities of Kabul and Afghanistan. And after today, I will be with you in the subject of Introduction to Business Finance. Dear students, let's start with the lecture 1, the role of financial management. Dear students, as the subject name is business finance, you better know about the business and finance. There are two words, first is business and second is finance. Business means any activity that is undertaken for the purpose of profit is called business. But this definition is not complete, because if we look around us, there are a lot of people who are working in the society, who are doing business in the society, but their businesses are illegal. Illegal businesses such as human trafficking, marijuana business, wine, alcoholic business, which are haram by Islam, transfer of goods without taxes, selling of goods without taxes. All these businesses are illegal. So we cannot say they are businesses, they are crime. They are doing crime. The name of these businesses are not businesses, they are crimes. So any legal entity, we can add a word of legality. Any legal activity that generates profit is called business, or any legal activity that is undertaken for the purpose of profit is called business. Second word in the business finance is finance. Simply, finance means money. Finance means money, but the money which is managed, managed, planned, that is called finance. That is called finance. The role now, let's start with the role of financial management. In lecture 1, we discuss these three topics. In lecture 1, we discuss these three topics. What is financial management? What is the goal of the firm? Third, organization of the financial management function. First, what is financial management? Financial management concerns three main activities. Three main activities: acquisition, financing, and management. Acquisition means purchases, purchases, acquiring something, acquiring something. Financing means how to purchase that thing. And management means when the things are purchased and financed, after that, how to manage these purchased things. Acquisition is the left hand side of the balance sheet. If you remember balance sheet, acquisition means the left hand side of the balance sheet, which are assets. Which are assets. Which are assets. Financing means the right hand side of the balance sheet, which are liabilities and owner's equity. Both of them makes a balance sheet, and this balance sheet is managed. The management of this balance sheet is called management. So acquisition means purchases, acquisition means acquiring assets, acquiring assets. Financing means how the assets are acquired, from where the fund came, the ways of coming of funds, when the financed with the acquired the assets, after that how we manage these assets, that is called the financial management, but some overall goal in mind. Why we acquire the assets, why we finance these assets, why we manage these assets, because of us, there is something goal, there is something goal, some goals in the mind of businessman. Why he manage the finance? Because he has an overall goal in mind, which we will discuss later. Investment decision or acquisition, acquisition or investment decision. The left hand side of the balance sheet, most important of the three decisions. It is the most important of three decisions of the financial management. What were the financial management's three main decisions? Acquiring, financing, and management. The first we discussed before, that is acquiring. Acquiring mean investment decisions. Before I told you acquiring asset. Acquiring assets is a investment. You buy a building for the purpose of school. So the buying of this building is an acquiring of assets. Acquiring of assets. They you buy a motor vehicle or car for the purpose of business. So acquiring of this motor car is an investment. Investment. So the acquiring of any asset is an investment decision. So investment decision, before I told you, falls in the left hand side of the balance sheet. What are the components of the left hand side of the balance sheet? Short term assets and long term assets, non fixed assets and fixed assets. Clear? The most important of the three decisions, what is the optimal firm size? In this decision we decide that what must be the firm size. Firm mean business, firm mean organization or corporation. What will be the corporation's size? What will be the organization size, firm size? Second, what specific assets should be acquired? Which asset should be acquired? And third, what assets, and if any, should be reduced or eliminated? You better know about that no assets will work for the life, whole life. It will it will be comes to end in the future time, in the some future time it will come to end. If you remember the depreciation in accounting subjects, every asset has a depreciable life. If every asset has a depreciable life, so this depreciation shows that some assets must be eliminated from the organization. So these three questions are related to the investment decision. Next comes the financing decisions. Determine how the assets, it means left hand sides of the balance sheet. Before I told you that assets, investment decision, will be financed with the right hand side of the balance sheet. Before I told you the right hand side of the balance sheet is liabilities plus owner's equity. Liabilities plus owner's equity finance the left hand side of the balance sheet, which are assets, long term and short term assets. These long term and short term assets are financed by the right hand side of the balance sheet, that is liabilities plus owner's equity. So we will we will answer the questions like this. What is the best type of financing? Which type will be feasible for us? Which type of financing is feasible for us? Either we go to the owner's equity 100% and 100% earners equity. Either we go to the 50% earners equity and 50% is taken loan from the bank. So these are which type of the financing type is feasible for us, best for us. Second, the answer of the what is the financing mix. Before I told you 50% owners equity, 50% from the loan from bank. Either we can say 25% from the loan from the bank, 50% from owners equity, and 25% loan from the mutual funds. May be possible. Some organizations go through 25% honors equity, 25% loan from the bank, 25% loan from the mutual funds, 25% issued shares of the organization or offered stocks in the stock market of the organization. So this is the financing mix. So all these ways are the funds provider, fundraisers for the organization. So what is the best dividend policy? If you issued stocks in the stock market, in the stock market you issued stocks, so you will pay something extra for these stocks. That is called dividend. The person who purchases the stocks of the organization, he will expect something extra without their wealth. So this person will expect something extra without his wealth. This extra is called dividend. When we pay profit to the stockholder, that profit is called dividend. So what will be dividend policy? There are different dividend policies in the finance. Some organizations go through paying out the dividend yearly basis. As they calculate the profit of the organization and calculate the earnings per share, they pay out all the dividends to the stockholders. Some organizations pay 50% to the stockholders, pay 50% dividend to the stockholders. 50% dividend is reinvested by the organizations. Some organizations paid zero dividend, and the money and the dividend is reinvested in the organization or any other project. So these are the dividend policies. So organizations choose a best dividend policy for them, for their self. The next, how will the funds be physically acquired? How we can acquire the funds physically? So in the financing decision, we must answer these four questions. Clear? I hope you are understanding the explanation, my language. Next comes the assets management decision, third part of the financial management. Two parts, we already have studied two parts. First part was the investment decision, second part was the financing decision, and in the third part we are going to discuss the asset management decision. Asset management decisions. It means that how do we manage existing assets efficiently? Efficiently means using less time, using less assets, less money, and getting more profit. So this is called efficiently. How we manage the existing assets efficiently. Financial managers has varying degrees of operating responsibility over assets. Operating responsibilities means they have different policies regarding the operations of the assets. Greater emphasis on the current assets. So these are the assets. These are the fixed assets. Before I told you the left hand side of the balance sheet, which is called assets. Organizations have different operation systems, different operation policies for the different policies for the assets. Some organizations emphasize on current assets management, and some organizations emphasize on fixed assets management. But most of the organizations mostly emphasize on current assets management rather than fixed assets management, because current assets are the assets which are easily converted into the cash. You better know about the balance sheet, left hand side of the balance sheet, that first comes the cash, then account receivable, huh? Then account receivable, then inventory, then marketable securities. These four are the main types of the short term assets. Short term assets are current assets. So if you need money, simply take out from the cash. If you again need extra money, you can collect money from the account receivables. If you again need extra money, you can sell out the inventory which is finished as a finished goods or stocked in the warehouse. If again you need to the raise your fund, need cash, then you can sell out the marketable securities. So these are the assets which are easily converted into the cash in a short period of time. So most of the organizations in the world concentrate on the short term assets or current assets rather than fixed assets, because once you buy a building, it will not be easily converted into cash, it will not be easily sold, because it's a fixed assets, it's a long term assets. Once you buy a car is not a fixed current assets, current asset, it will not be easily converted into cash. So most of the organizations concentrate on the current assets. So this is the asset management decision. Now next part of the today's lecture is the goal of the firm. Before I told you, if you remember, in the definition of the financial management, there was a word, some overall goal. Hmm? Acquisition, acquisition, mostly concerning with the acquisition, with the financing, with the management of assets, with overall goal in the mind. So that overall goal is the maximization of shareholders wealth. Maximization of shareholders wealth. This maximization of shareholders wealth needs some processes, needs some activities, that are acquiring, financing and management. Why they do that? Because of maximization of shareholders wealth. This shareholders wealth is not easily maximized. You should be acquire a feasible asset, you should acquire a feasible a feasible fund, you should manage thoroughly, tactfully and planfully all these assets. Then you can maximize the shareholders wealth. Value creation occurs when we maximize the share price for current asset shareholders. How we know that we maximize the shareholders wealth? When we value created, when we value created in the share price. Today the share price of the stock, share price of the organization is $10, tomorrow is $12, after 1 year it's $15. So it means that we are creating value in the share price. This share price shows that we maximize the shareholders wealth. If value creation this does not occur, it means that we sold out our share price, our stock, in $10. After 1 month it became $9. The price of share became $9. After 1 month again it is $8.5. It means that our share price is decreasing, cutting the value. So it means that we fail to acquire a good asset, we fail to acquire a good financing system, and we fail to manage all these assets. So this means that we are fail. So every organization has a main goal, that is shareholders wealth, maximization of shareholders wealth, increasing profit. If you remember, in the start of the lecture, I defined the word business. There was a word, the definition of the business, there was a word. Any legal activity that is undertaken for the purpose of profit. That profit, that profit is maximization of shareholders wealth. If the profit is not maximizing, it means that we are not maximizing the shareholders wealth. Clear? There are some shortcomings of alternative perspectives. Profit maximization. Some organizations concentrate on profit maximization rather than wealth maximization. These are two different concepts. One we studied in the last slide, that was wealth maximization, and this is profit maximization. Wealth maximization and profit maximization both are best for the organization. Organization must concentrate on profit maximization and on wealth maximization, but wealth maximization is good, is the best way, but profit maximization has some shortcomings. What is profit maximization? Profit maximization is firm's earnings after tax. If you remember the income statement, if you remember the uh, income statement, in income statement there is a word that is earnings after tax. After tax earnings are the maximized. So when organizations start to increase the after tax earnings, then they will face some problems. What is that problem? Could increase only current profit while harm the organization in the long run. In the long run, the example of this profit maximization in Kabul, you better know. You can see around your society there are a lot of for pupils schools for pupils. If these schools uh, hire the lectureship teacher staff, so this teacher staff has the salary not more than 10,000. Every teacher has not more than 10,000. So if a person has a master degree and he want to teach in a school, will he accept this offer? 10,000 Afghanis? Will he accept? No, because he is a master. There is difference between master and simple diploma holder. Simple diploma, he is graduated from the higher secondary school, FSC. So all those people who are teaching in the school are simply diploma holders. Why? Because they are able to, they are only able to find out 10,000 salary jobs. So they simply go to the teaching field. If the school will pay 40 to 50,000 Afghanis to the teachers, then all the master degree holders will go to the schools for teaching. Then you can differentiate the quality of teaching of the master degree holder and the quality of teaching quality of the diploma or FSC degree holder. But there is a huge difference. Quality will be increased with the master degree holder. Quality will be decreased with the bachelor degree holder. So this is problem. These schools only concentrate on current profit after tax earnings, not on the long run. They remain same for the whole life. They cannot expand their business. They cannot make any wealth maximization. They cannot grow their business because of only profit maximization. Clear? This is the shortcoming of alternative perspective. Next comes the strengths of shareholders wealth maximization. We studied the shortcomings of the profit maximization. Now we study the strengths of shareholder maximization. There is a strength. What strength? Take account of current and future profit. Before I told you, the organizations concentrate on the current profit as well as future growth, future profit. They concentrate on both of these. The timing, duration, risk of profit, earnings per share, dividend policy, and all other relevant factors. So these are all strengths of the shareholders wealth maximization. When organizations do shareholders wealth maximization, they concentrate on current and future profit. And EPS means earning per share. They increase the earnings per share. The timing, the duration of the organization, the timing of the organization, the risk of the future risk of the organization, the profit, earnings per share, the dividend policy. Before I explain the dividend policy and all other relevant factors. Next topic is the modern corporation. The modern corporations are of two types. One is contain modern corporations contains two parts. One part is shareholders, the second part is management. The corporations are made by shareholders and management. Shareholders invest and management staff manages the business. There exists a separation between owners and managers. Corporations uh, run are not run by the shareholders. The corporations are run by the management. So there is a separation between managers and shareholders. Then what will be the role of management? Management acts as an agent for the owner, for the shareholder of the firm. So management is an agent who acts for the behalf of behalf of the shareholders. As an agent is an individual authorized by another person. He is authorized person. He has authority to run the business, called the principal, to act in the later's behalf. So principal authorizes a person, that person run the business, manages the business. This person is called agent. There is agency theory. Agency theory, principal must provide incentives. Now, before we explain the wealth maximization wealth is not maximized of the shareholders without incentives. Agents, when agents are happy, then will be happy. If the agent is unhappy, then shareholder will not be happy. He will be remain unhappy because the the agents are unhappy. So agents must be provided incentives. Agents must be provided incentives so that management act in the principal's best interest and then monitor results. If you provide incentives to the agents or management, senior managements, so this incentive motivates the management, motivates the agents, and then he will perform in the best interest of the shareholder and evaluate, monitors the result. Incentives include stock option. First and best incentive in the world is stock option. The senior management, this is such like we can say CEO, chief executive officer, CFO, chief financial officer, CTO, chief technology officer. All these are the senior management, so they must be provided some stocks, they must be offered some stocks of the organization. So on, they become the owners of the organization, and then they will work hard, they will manage thoroughly, they will manage the business for the purpose of shareholders wealth maximization, because they are also shareholders of the organization, they are also owners. So this ownership of the senior management motivates the management, and this is the stock option. This is also called the executive compensation. Executives must be compensated with the stock options. If you are not providing stock options, there are another facilities, another incentives you can provide them, such as prerequisites, bonuses. Provide them house without rent, provide them transport system, provide other facilities in the job. So these are all bonuses to motivate the agents. This is agency theory. Organization of the financial management function. Organization of the financial management function shows there are two types of finance. Vice president of finance is divided into two. One is treasurer, second is controller. Treasurer works for the capital budgeting, you better know about the capital budgeting. How to invest, cash management, how to manage the cash money, credit management, you better know about the credit, dividend disbursement. Before I told you the dividend policy, that they are not paying the dividend to the uh, uh, shareholders, stockholders. Zero dividend policy, they disburse the dividend, invest this dividends in organization. Financial analysis and financial planning, pension management, they also work. Treasurers work the pension management, the insurance, the risk management, the tax analysis, planning. All these activities are related to the treasurer. The second part of the finance is the controller. Control makes only the books, cost accounting. They record the cost of the organization, they manage the cost of the organization, they work on the data processing, on ledgers, general ledgers, government reporting, they make reporting to the government. Internal control, they also work on internal control, internal part of the organization. Preparing financial statements, they prepare financial statements such as journal, ledger, and income statement, balance sheet, profit and loss account. All these accounts are statements are prepared by the controller. Preparing budgets, they provide budgets, they prepare budgets for the next years. And preparing forecasts, they forecast for the future for their organization. This was your today's lecture. Thank you, dear friends. I will upload this in my YouTube channel. This lecture is uploaded by me in YouTube channel. I will provide the link of this video in the WhatsApp group. I will share it. You can simply click on the WhatsApp group link, and you will find out the video. Thank you so much. Have a good time, and Allah Hafiz.